Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockborn. This is a podcast where I share the stories, views, opinions and career journeys of the movers, shakers, innovators and leaders in the real estate industry. Welcome to the People, Property, Place podcast. Today, we're joined by Wajeha Qureshi, Associate Director at Cadillac Fairview. Cadillac Fairview is a globally focused owner, operator, investor, and developer of best-in-class real estate across retail, office, residential, industrial, and mixed-use asset classes. Wholly owned by the Ontario Teachers' Pension Plan, CF manages in excess of 40 billion of assets across the Americas, Europe, and Asia. In the past couple of years, Cadillac's landmark European investments have included establishing a 3 billion logistics joint venture with Boreal Investment Management, investing into a 1.5 billion BTR partnership led by Long Harbour, and buying into a £700 million life science project, Oxford North, and acquiring a stake in Stanhope. Wajeha is a graduate of both Cornell University and Harvard University, where she studied a Bachelor of Architecture and a Master's in Real Estate Finance. She's worked for a number of leading real estate businesses, including Hines and GIC, and it gives me great pleasure that she's joining me on the podcast today to share a little bit more about her career and how she sees the market presently. Wajeha, welcome to the podcast.
Thank you for having me.
Not at all. Well, look, we'll come on to some of your career moves and talk about Cadillac Fairview a little bit later in terms of the conversation. But a place I always like to start these conversations is, how did you get into real estate?
Okay, so my career path into real estate isn't a typical career path. I actually started in architecture. When I graduated, I had a great interest in art and physics when I graduated high school. And so the right path for me seemed like architecture. And of course, when you're 18, you don't really know what you want to do. So I went to Cornell for architecture. It was a professional degree. So it was a 5-year degree. And I graduated with a professional qualification, so I could practice as an architect. But while I was doing the program, I actually realized I had a great interest in property and not just the design side of it. And namely, I think one of the biggest factors right after I graduated was my first job working for an architecture firm in Pakistan, in my hometown, Karachi. We were doing like a big development on the seashore that was funded by a Middle Eastern investor. And just working back and forth with the developers, I realized there's more than just design that goes into a master plan and how the phases work together and the capital that goes into it. And I was quite intrigued. So I applied for a master's in real estate and basically made a career switch at that point in time.
So how did architecture even come onto your radar as like a career path?
When I was in high school, my uncle was having a house built by the architecture firm I ended up working for after I graduated in Karachi. And I remember going to the site and seeing the house come up. And I was just fascinated by how they designed the house and how they had been working with the architect and they'd been influenced in that. And yeah, I had always had a mix of interests in high school. I'd done sciences, but also art. And it felt like the right combination. Especially a professional degree, you have to do structural engineering. There's quite a bit of maths involved as well. So it felt like the right mix of both art and engineering for me. And that's why I decided to do architecture.
We spoke off mic that you grew up in Pakistan, but also in Canada. You kind of spent stints in both. How did you choose, or how? Because you ended up finishing your high school, right, in Pakistan?
In Pakistan, yeah. So basically, when I was 3 years old, my family immigrated to Canada. I finished primary school there, so up until grade 6. And then we moved back to Pakistan to be closer to my extended family. And I did my O and A levels in Pakistan. It was O levels at the time because I tell people this is like, no, you can't have done O levels. You're too young. And I'm like, yep. Pakistan's like 2 decades behind the rest of the world. So I actually did do O levels. And then after I graduated from my A levels, I applied for university in the US. And yeah, I ended up going to the US for undergrad, did my master's there as well, spent about a decade in the US, and then moved over to the UK.
So how did you choose Cornell as a university? And then where did Harvard come into the frame? You just had to get both.
Yeah, no, this is this is a really funny story. So Cornell is like number one in architecture for like decades. It's been number one for like 20, 30 years. It's a long-standing professional program. Most universities in the US don't offer the professional degree anymore because it's so long. A lot of students don't want to do it right off the bat. Now they do a 4-year degree. But it's the only one, that had a fully professional qualification at undergrad. It was the top-ranking university in the US. And they had a big scholarship for Canadians, actually, which was a huge plus for me. This is slightly embarrassing, but I watched a movie in high school called The Perfect Score. And it's supremely hard to get into Cornell architecture. It has the highest sort of applicant to space ratio, more than Harvard, more than any other university. That specific program has the highest ratio. So this entire movie is about a kid trying to steal the SAT scores because he needs a perfect score to get into the Cornell architecture program. So I watched this movie and I was like, I'm going to do this. I'm going to get a perfect score and I'm going to go to Cornell architecture.
And you did.
And I did.
And you topped. I don't know. I hope I'm not disclosing personal information here, but you topped the rankings in Pakistan. You topped the rankings in Pakistan, didn't you?
I did. Yeah. So I wasn't, because my family had moved back to Pakistan. I don't usually disclose this, but I embarrassingly did 17 subjects in my O levels because I knew I had to get into a certain school that was recognized abroad for my A levels. And so I did a ton of classes privately and got the highest number of A stars that year in Pakistan in my in the country.
So that's how you got into Cornell and then Harvard.
Because I knew if I wanted to get into an Ivy League, I needed to get those scores. I mean, coming from Pakistan, you have to differentiate yourself. There's a lot of top performing students, but if you don't differentiate yourself in some way, it's either grades or something else that you've done. Your application just doesn't get looked at.
But it's a combination clearly of immense intelligence naturally, but then an insatiable work ethic as well has enabled you to certainly kind of get into those schools.
I worked really hard. I remember I always have this discussion with my husband. He's British and he also obviously did his A levels. And I'm like, you didn't work as hard as I did. There's a much harder hurdle because we're ranked against other students in Asia and Asian students are so hardworking. He's like, no, I also got A stars. I was like, that doesn't mean the same thing. Your A star is at 80%. Mine's is at 95%. And then I'm like, to add to that, we didn't have light half the time because the electricity would go out and it was burning hot. So
you outright won. Did he go to Cornell as well?
No, he went to Oxford.
Okay, fine. Just a low achieving couple then. So architecture came into the frame because your uncle was building a house in Pakistan and you liked the design and the tangible aspects of it. Was that literally your kind of view into real estate and what property was at the time?
There was that. And then my grandfather on my dad's side is a real estate lawyer. Of course, in Pakistan, that means something very different. It ends up being family law more than anything because of inheritance rights and stuff. So I had some exposure to it from there. I was exposed to sort of property and him talking about property at a young age. And then I was exposed to architecture in that sense. But yeah, it was kind of always in the frame in one way or another.
So you went to Cornell, did your architecture as a professional course, and that opened your eyes to what the broader ecosystem of real estate and the different options that a career could take you.
Yeah.
Can you just expand on that?
So I mean, architecture, to be perfectly frank, when I graduated from architecture, I also realized, as I was a scholarship student, that working in the firms that I wanted to work wasn't financially sustainable for me. Graduating as an architect, as a sort of junior architect, it's not very well paid. I worked for some great firms. I worked for Shigeru Ban, who's a Pritzker Prize-winning architect. I worked for the company that did the High Line. So I worked on phase 3 of the High Line, as a work study placement when I was at Cornell. And they were all great shops, but there's very few people who get to sort of that high profile starchitect level. And a lot of people end up working for the likes of SOM and others, which are great, but it doesn't mean you're designing a museum or the signature building in a city necessarily. And for me, it was also interesting to see that it wasn't just the building I was interested in when I was working on these master plans. There's other pieces that go into a city, and there's other moving parts that aren't necessarily just the design. And I was curious about that. And going back to the 17 subjects that I did privately, I had also studied accounts and economics and all of these other things that I could rely on in the future when I did my master's, because I had that from my O levels.
So you had that background, that understanding,
Yeah,
that kind of core
I had
base.
the base level of understanding.
So how did Harvard come about, and how did you choose that school and that course?
So there's very few master's programs that actually specialize in real estate. It's Harvard, Columbia, Cornell, and maybe a few others. But I basically applied to those three. I got into all three. And then I was talking to my thesis advisor and the person who'd written my recommendation for Harvard and all the others. And he sat in both one of the programs in Cornell's real estate program, but also in one of the design classes at the architecture program. And I was like, well, where should I go? I trust your opinion. And Professor Henry said, you should go to Harvard. A, the name will carry you. B, there's a lot of connections you can make to the real estate industry there versus being in Ithaca, New York, where Cornell is, which is a bit more detached. And you already have sort of the New York contact. So it'll be good for you to go to a new city and make new connections. And he valued that program. And it was interesting talking to a professor at Cornell who was actually telling me to go to a different school. So I listened to him and I was like, all right, I'll go to Harvard.
So you went to Harvard, and then following Harvard, can you just run me through your kind of first job out of Harvard, having kind of like realized there's so much more to real estate than just architecture?
So my first job actually was as in the real estate industry properly was as an intern between my first and second year at Harvard. It was at L&M Development Partners in Manhattan. They do a lot of affordable housing. I was doing a lot of affordable housing courses as well at Harvard, and I was a TA for one of these classes. So my professor had referred me to this organization, and their first project was a condo building in Harlem. And so I got exposed to residential at a very early stage. And it was a residential development. And I remember going around Manhattan and looking at like property prices with Tal Metzger, who I'm still in touch with, great guy. And Tal and I would just like be these like buyers. He passed me off as like a sister from another mother. I was like, Tal, this doesn't work. I'm brown. Like, I don't think people will believe this. He's like, no, we're renting a place together. Don't worry. So that was sort of my first experience. Of course, I was an intern, so I didn't do too much modeling or anything at that point, but really got to look into how the cash flows are built for a development. And then my first real job after I graduated was working for a developer in Boston who did a lot of multifamily and student. And so that was really looking at multifamily projects around Boston and working with one of our major investors, Blue Vista Capital, who are out of Chicago, and we're investing in those projects.
So at this stage, you'd kind of known that there's lots of different kind of avenues you could take your career. Were you really specific around the type of asset class that you wanted to work on, or the type of business with a business, plan to work within, or were you quite open-minded?
I was very open-minded, and I think actually it was beneficial because at the time I don't think I understood how much that would influence my career path. Because I think less so than other people going into real estate. I think nowadays there's so much more information available to students, and you can easily find things online. When I was growing up, like we had dial-up internet. Like I didn't have the resources and information available. I didn't know that you do an investment banking internship for 2 years, or you do a finance or economics degree, and then you do banking, and then you go into private equity. Like I wasn't even aware that was a career path. And so I kind of fell into real estate obliquely through this path. But in my first job, when I started working for this developer, obviously I had sort of the background of how JVs are structured because it was taught to us at Harvard, but I really got to see that firsthand. I just kind of like fell into this career and really got to learn different types of asset classes as well. So we started looking at life science as well, because life science is quite big in Boston. Kendall Square near MIT, there's a lot of development there. And there was new development in Alewife, which is a part of Cambridge further out. And we were looking at sites there and possibly rehabilitating sites that had environmental issues. As a developer, they were quite keen on sort of making different types of sites work. And so got exposed to different asset classes that way, but really wasn't choosing what to do. Things just kind of came up, and I was really willing to do anything within the real estate industry and just sort of pull up my bootstraps and learn.
So you cut your teeth as an analyst?
Yeah, I cut my teeth as an investment analyst, looking at different sort of acquisitions as they arose. It was all development deals. And it would literally be like, here's a map of a site. And actually, at my first job, Jay Doherty, who's the CEO of Cabot and Forbes, where I worked, really loved that I was an architect because that meant that he could do a quick underwrite with me without taking it to any architecture shop, because he could just give me a site plan. I could draw out the setbacks and the massing we could achieve post-planning, and we could do a quick and dirty underwrite in-house because we were like 5 people. It was me as an analyst and another analyst. And we could just like run the numbers really quickly without having to do too much of the heavy lifting and hence costs to actually submit a bid.
Yeah, quite. So you can be much faster.
Yeah, much
kind of
faster.
Just churning through these deals.
Yeah, exactly.
So you were at Cabot and Forbes for a couple of years. What prompted the move away from there, and how did that come about?
So I met my husband in Boston. He is British. And that really pulled me to the UK. That was the main factor. I think for me as well, my husband always says this. He's like, you only do 10 years in a country and then you move. He's like, you were in Pakistan and then you were in Canada. He's like, you never live for a lot. He's like, I think when our 10 years are up, we'll leave the UK. I'm like, no, I'm stuck now. I'm staying. I'm done. I'm done moving in life. But yeah, I was intrigued to move to a new place as well. I liked that the UK is more broad and open. In the US, when you work on deals, you're basically just, and especially when you're working for a local developer, you're just working on deals in Boston, unless you're working for a national company across the States. But I felt like it would broaden my horizons as well. And so he was graduating from Harvard. I was working already, and he had to come back. Trump had been elected. His company said they didn't think they could sponsor him given the current situation. And so I started looking at jobs quite early, and all of a sudden found something at WP Carey very quickly, faster than I expected, and sort of made the move over. I think at the time, even when I was applying, to me, it was still real estate. I don't think I fully understood at the time that I was making the shift fully from sort of development to investments. WP Carey to me was a real estate company. I think now when I look back on it, it is more of like a sale and leaseback credit investing shop, which really like helped round out my skill set. But I was just applying to like real estate companies.
So a couple of questions for you. One is like navigating the move, because you've got Canadian citizenship, Pakistani citizenship, and you're working in the US. How do you make that move? Because there's quite a lot of people who want to make the move over from North America over to the UK, and there's the sponsorship issues. So how do you do that? And then the second piece is, can you just like expand on what you mean about the sale and leaseback credit play, just for people who might not understand or be able to join the dots together?
Of course. So first question, making the move with like different visas and stuff. There's actually a youth mobility visa program for Canadians and Australians. If you're under 30, you can come to the UK and work like literally as anything. You can be a bartender. You just apply for the youth mobility visa. You get it really, really quickly, and then you can move over. Having a Canadian passport really helps in several countries because you can also do that in the US. There's several different professions where it's called a TN visa. It's under NAFTA, and you can work in the US that way. Outside of that, yeah, you would need sponsorship. But I think it's great if people are from Canada and Australia and want to come to the UK to work. So I kind of knew that was an option. I did eventually get sponsorship and a spouse visa. And then your second question was
more about the sale leaseback credit and the investment play, and how that is different from a developer, and how that kind of like rounded out your experience.
Yeah, so WP Carey, they primarily do sale and leasebacks and single tenant assets. And it's a REIT in the US, which is how I got the interview initially. I interviewed with them in New York and then the London office. And basically, A, it's standing assets. It was different from the development deals I was doing. And B, being single tenant, what they look for, it's more bond-like in that they want fixed income for a longer period of time that's ideally tied to inflation. And so when they look at an asset, rather than looking at the asset itself, they're looking at the tenant. Because if you have a 25-year lease from one tenant, you're relying on the corporate credit. So what it was credit underwriting more so than real estate underwriting. And at the time, I think I didn't realize that I was learning this new skill set. I remember I did their case study and I spent like weeks studying for it, because this was completely new to me. I was looking at a corporate and I was looking at how their credit was structured, what kind of guarantees we were getting from the corporate, what their P&L and balance sheet looked like, what their historical P&Ls looked like, what we think it would look like in the future, which was not real estate. And I think when I started working there, I did realize I wanted to move closer to the real estate industry. So I knew that this would be a shorter stint for me, but I think at the time I didn't value as much as I do now what I learned in that year that I worked for WP Carey. Because had I not done that year, I wouldn't have been able to do platform investing today and looking at real estate corporates today.
Okay, so you were there for about a year.
Yeah.
It got you kind of the move back over to the UK.
Yeah, exactly.
And you learned an entirely new skill set, which we'll build on further in this conversation, because I think that platform piece is really interesting, and I'd be keen to expand on that. You joined Hines as an associate, which is obviously like a US developer, operating partner. Can you just expand on how that role came around and what you were doing? Because I think that probably opened up to kind of having a little bit more of a European flair to your experience.
Yeah, so Hines, I was trying to get back to what I had been doing, which was multifamily and student housing, essentially, build to rent, as we call it in the UK, because it's still quite a nascent market compared to the US. And I found Alex Knapp's name on a real estate article. Alex Knapp is the CIO of Hines. And at the time, he was head of the living team at Hines. And he was really doing sort of living sector investments in the UK and in Europe. And I found his name because he'd gone to MIT's real estate program, and Harvard and MIT's real estate program are like, they share classes. So I'd basically done my entire second year at MIT, and I knew professors that Alex had studied with and kind of like found him and then tried to reach out to him through various ways, because he also had made the shift from architecture to real estate. He used to be an architect. And then I basically kind of just like reached out through various avenues. I don't think he was even hiring. We had a conversation. He was like, "You've done resi. This is great. We need people who've done resi. You should join our team." And yeah, I just started a member of the living team at Hines after that.
Interesting time in that like resi market. Right,
yeah.
It's becoming much more institutionalized.
It was becoming much more institutionalized. So I joined, the way Hines is structured is they have their development and operating team sort of across Europe. And then in London, they have sort of European headquarters, which also manages the various funds. But the living team at the time kind of sat across everything. They worked with our local offices along with the funds teams to underwrite an asset class no one fully understood. So it was helpful in that we were helping build sort of the template for how we underwrite these and how we manage these properties. So at the same time, they were building up Aparto, which was their student housing brand, and looking at how to build property management in BTR as well.
And then set up that infrastructure from local operating deal sourcing and replicating that across lots of different countries, making it like uniformed out of the European HQ where a lot of the main decisions would be made.
So while I was there, we did quite a few deals within resi and student, and then we set up the JV with Quadreal, which is a pan-European living venture that was set up between Hines and Quadreal at the time.
Can you talk to me about that JV? Because I know you were actively involved in it, and what the mandate was and how you go about raising capital from LPs.
Yeah, so the mandate was basically, let's deploy about $1 billion in European build to rent. And it was primarily development because that's sort of Heinz's core skill set. And the strategy was essentially, this doesn't really exist in the markets today. And so we need to build it, and creating the case for build to rent in Europe, why we thought there was rent growth, which areas we wanted to target. And so actually setting up a JV was more pitching the strategy to a variety of investors and seeing if they sort of align with your target returns. And then you get to sort of the term sheet stage and what kind of promotes you on, what sort of expectations they have from exit and things like that.
Quadreal is obviously a Canadian HQ'd business. Was that helpful or?
No, not. I mean, kind of. I guess I was involved in the conversations, but I don't think they realized I was Canadian.
I was just trying to think maybe, helpful from maybe like a cultural understanding and like mindset, or can you like push that all into like North American? And
I think it does help when the operator is North American and the investor is as well, because then you kind of understand when you're talking to a North American IC as part of your own company what people are coming from, because you need to start at a sort of higher level to describe the markets. So I think that did help actually. Yeah.
So did your experience in the sale and leaseback capacity at WP Carey help your time at Hines, or was that just like a new skill set or building on a skill set that you had acquired at Cabot and Forbes in the US?
Yeah, I don't I think then it didn't fully, I was looking actually at a platform investment when I was at Hines in the service department space. We didn't end up doing the deal at the time. Probably not the right timing then looking back. But that it did help with that because I was able to analyze sort of the corporate finances of the company for that investment. But I think more so it's helped in my career today, post Hines, when I've been looking at sort of platform investing at CF. Yeah, it's helped massively.
Talk to me about your time at GIC, because GIC is a sovereign wealth fund.
Yeah.
And on this podcast, we've spoken a lot about various different LPs and operating partners and property companies, but we haven't really spoken about sovereign wealth funds, what they are. So can you just maybe tell me what a sovereign wealth fund is before we kind of get into maybe the role and what you're involved with?
Yeah, so I think the best way to understand it would probably be a sovereign wealth fund would manage sort of the sovereign assets of the country, which then pay out pensions for the sort of federal pensions as a whole. So I think it's not too dissimilar to, for example, an Ontario teacher's pension, who we're wholly owned by, which manages the pensions for a specific group of people within Canada. But for example, CPPIB, which is the Canadian Pension Plan Investment Board, would be similar to a sovereign in which they manage sort of the federal assets. And so, yeah, not too dissimilar, but obviously a bit different when I guess it's a bit more government related rather than just a separate pension entity. And so a bit more regulation in that sense, but not too dissimilar.
And GIC is the Singaporean sovereign wealth fund.
Yeah, it's a
and is it second behind Norge, the Norwegian,
so
in terms of assets under management? Or it's definitely kind of up there in terms of
it's
AUM?
up there. We weren't allowed to say, and we're still not allowed to say what the AUM is. It's high. I think the concern was that if anyone ever reveals the total AUM, because the currency can then be attacked, because then you can see what their total holdings are. But yeah, I think in public records, it's like several hundred billions. Yeah.
And then that's obviously all allocated or carved off to various different asset classes. And a portion would obviously be allocated to real estate. And then that'd be niched down further in terms of risk and geographies that is allocated to.
Exactly, yeah.
So your role at GIC, you're an assistant VP there. Can you just tell me about what was your job? Why did you take it and what were you responsible for kind of doing?
So I think I took it because at the time when I was at Hines, I was doing resi, but then I realized I was actually getting quite restricted to just living. I wanted wider exposure. And then I realized actually when I was doing the service department platform, there's actually a bit of corporate investing involved in real estate as well. And I saw GIC had done quite a few platforms, and we'd been talking to them for the JV that we were raising. And so I had some exposure to them already. And through that, I started talking to them about opportunities within the team and realized that there was an opportunity on the UK team. And so really just applied for that. And my role was covering residential again. And I was also looking at office in the UK. And I actually started right in the beginning of COVID and was given the retail assets to manage after someone had stepped off of them. And I was like, great, I could learn all about retail distress. GIC owns a few shopping malls in the UK. One of the biggest ones is Metro Centre, which was operated by Intu, and part of that collapse. So it was a great learning experience during COVID. That was one of the things that I worked on. But among that, I also looked at resi, a lot of built to rent, and a lot of office as well. Yeah. And life sciences.
And life sciences too.
Yeah.
GIC don't write small tickets, do they?
No.
So can you just...
My deal sheet went from 100 million to 1 billion.
And so can you just expand on why that is the case? Just from a mindset and an investment perspective, because I think some people will be listening to this and it's just useful to know, deal volume and quantum and like why that's important for particular investors.
It's just the volume of capital they have to deploy. They have certain targets. And at the time when I was there, real estate was 7% in terms of allocation. They wanted to increase that to 15. I don't know how it's changed since, but to just deploy that volume of capital, And given the number of people they have on the investments team, you really need to start writing bigger checks and looking at sort of macro level strategies to be able to do that. And it just doesn't work if you're doing sort of smaller tickets. That's honestly really it. And I think it affects the way you look at the real estate market as well, really, because if you look at an asset class and you can see, okay, maybe there's growth in it and I can get a great IRR, but I can only actually deploy maybe a couple $100 million into this strategy, then does it really make sense on a GIC scale unless I can aggregate it and make it a larger portfolio? And then how long will creating that portfolio take? And then you have to weigh the costs and benefits of it.
And then who are you going to exit it to?
Yeah, who are you going to exit it to? And so I think GIC has struggled with this potentially as well, because you can see that they sort of recapped Mileway, for example, because those large checks are really, there's only a few people who can really take those down.
It's one thing like raising the capital, the next thing is deploying it and finding the quantum of deals to be able to do that. GIC as a business, do they just invest directly into real estate themselves? Do they kind of build and scale and then like exit platforms? Or did they kind of just have a straight operating partner JV model? Or did they do all three?
So they typically have an operating partner, so they don't have sort of in-house asset management as such. And so they'll partner with, for example, British Land. They're doing a lot at Broadgate, for example, with them. A variety of partners across the spectrum. I mentioned Into, so they were doing retail with them a long time ago. Who else? They have P3, for example, in the logistics space. So a lot of the big pensions and sovereigns do this. So at CF, we have Boreal as an operating partner. We have Stanhope. We just don't have those in-house capabilities, but we have a partner, a GP alongside who can add that to the JV.
So why do you work in JV with operating partners?
It's the capabilities they bring. We don't have that capacity or the ability to do what they do, the property management, the asset management, the sort of direct relationship with tenants. We need that from our operating partners and really sort of being boots on the ground and involved on the asset on the day-to-day. And then we see from a higher level how the asset is performing.
So you provide the equity and the final sign-off and then some of the reporting to the ultimate shareholders. But then it's more about making sure that you're oversight of that JV partner who's doing some of the heavy lifting and bring deals to the table that you can kind of fund and run a plan on.
I think the one differentiation potentially between someone like GIC and us is that we do more direct deals as well, where we'll do one-off deals with a partner. So for example, with Stanhope initially, and even today, we have a lot of large one-off tickets. We have the large JV in Oxford North, but for example, when we did White City Place with them, that wasn't part of a wider JV. That was one ticket that we did to start off.
And that's with Cadillac.
Yeah, exactly.
So GIC, can you talk to me about how challenging is it to do portfolio deals and what is a portfolio or kind of corporate deal that you alluded to earlier?
So a platform deal, for example, perhaps this is sort of internal Cadillac Fairview speak, but a corporate deal or a platform deal would be looking at a business and investing in the operating business alongside a portfolio of assets. So the JV would be just looking at a portfolio of assets and investing in the property company that owns those assets. And then alongside, we like to invest in our investors themselves and to have that alignment with management.
That's an interesting evolution of the last few years, right? Owning a stake in your operating partner as well as providing the equity to them as well. Whereas historically, what do I know? But historically, it was like equity and then LP is the equity and then GP is the operating partner. And they'd co-invest a little bit of the money just so there's kind of co-invest. Yeah. But as an LP, you could kind of chop and choose or you could kind of back different horses, as it were.
Exactly.
So why Cadillac, and I know we've jumped around a little bit here, but why did Cadillac back operating partners and then take a slice, 50%, 25%, whatever it is, out of their business at the same time?
Yeah, so with Cadillac, I think this is what drew me to Cadillac as well. It is sort of a platform for a strategy and sort of backing a horse, so to speak. So whereas other pensions or sovereigns might look at a variety of capital partners, and we do the same, we look at a variety as well. But for example, where we do a lot of office in the UK with Stanhope, that's not to say we won't do it with someone else, but we are invested alongside Stanhope in the corporate as well. And so we own a 25% stake in the platform to get alignment with management and to make sure everyone's sort of on the same page.
And you did the same at GIC, right?
So at GIC, they do platforms, yes. I was involved in a couple platforms as well.
And platforms as well, like multi-jurisdiction, like big portfolio deals?
Yeah. So
or how would you or is that, you'd have a slightly different terminology for that?
Yeah. So when I say platform, I mean the corporate business, the operating partner. I think some people use it interchangeably and they mean large portfolio deals. So when some people say platform, they mean like a larger portfolio of assets. So yeah, we had both. We had large JVs, which some people say it's a platform. Sorry, these terms are always interchangeable and context matters.
That's why I'm just keen just to unpick it, because you know, I think if you don't know, it can be quite confusing, all the different terminology.
Yeah.
And so just trying to, one of the kind of the key tenets of this podcast that I want to try and get across is try and debunk some of this jargon, just so people maybe listening who are in a seat at the moment, but maybe want to move into the real estate PE space or go and work at a sovereign wealth fund,
it can get confusing.
Can just maybe understand like some of the context around it and how it works.
It's used interchangeably. So sometimes when I say platform, I mean corporate, but when a lot of people say platform, they mean sort of the portfolio of assets within a certain strategy. So they'll say we have a logistics platform, and that means they have a platform of logistics assets. It's a portfolio of logistics assets across various geographies, and that's their sort of logistics platform, so to speak. It's a JV that they've built of various assets across jurisdictions. Yeah.
And you invested in that at GIC predominantly,
exactly.
Just because of the scale and the tickets that you would write.
Yeah.
You would look at big,
large platform or
portfolio deals in lots of different countries with different structures from a tax, etc. perspective, and you would look at writing, $1.5 billion, $2 billion, one-off tickets to acquire and they could be like 20, 30 properties within that portfolio. It could be much bigger, right?
Yeah.
And from a mindset perspective, I guess GIC or these other sovereign wealth funds have got to like liability match themselves, or maybe not liability match themselves. They've got to, if they are responsible for the pensions of the people in their country, as well as other parts, they've got to make sure that they are honouring that.
Yeah.
Are they bound by 3 to 5 year business plans, or do they have lots of different buckets within that they might have 10-year strategies, 20-year strategies, as well as maybe some smaller, more kind of Yeah.
So I think so that's sort of done at a higher level within the sort of the actuaries and others who are looking at sort of that. But I think real estate in general, the bucket that it falls into is longer term investing, because the idea is you're going to hold these assets for the long term. So it's generally, even if it's perhaps opportunistic in the beginning, if you're doing a development, it would be, for example, develop to core, because the idea is you're going to hold these assets for the long term to pay the pensions of people back in Ontario, for example, or back in Singapore. And so you do really want assets that are high quality that you're going to be able to hold for the long term. And so there isn't that sort of mindset of, okay, it's a 5-year business plan and they're going to cycle out of it, because then you have to decide what to do with that capital.
So where does debt come into the frame within a business like GIC? I'm sure they're buying in cash when they do these platform deals on an equity perspective. Yeah. And I know they've got a separate debt strategy, or there's an exposure there. Am I right in saying that they literally just buy everything in cash because they can get sharper prices and then they'll refinance later, or they won't even refinance it later just because of the quantum of capital that they need to deploy into the market?
Yeah, I think at GIC, so I think at GIC it changes, because when I was there, it was a variety of, they can do all cash. Obviously, they change their sort of policies every year and they don't have to take on leverage. At Cadillac Fairview, where I've been for the last couple of years, we've looked at deals on an unlevered and levered basis. For us, we have sort of a maximum level of LTV that we'll take, but as long as it meets benchmark on an unlevered basis, we don't necessarily have to put debt on the assets.
Talk to me about Cadillac Fairview. I know I did a little bit at the top of this intro. How did that come about? Why did you want to go and work with Jenny at Cadillac? Because you were one of the early members of the team over here in London.
I do this a lot. I look at people in the news and I get interested in them as people. And I'm like, this person sounds amazing. And I'm like, I want to go work for them. So Jenny was featured, I think on like React or something, for acquiring White City Place. And she was one of the hires that Cadillac had made. And they were setting up a London office. And when they first came to London, it still is super exciting because they have quite a bit of capital to deploy. And they're really at that growth stage in their journey and entering sort of different asset classes across Europe, whereas other
pensions and sovereigns might be more established across Europe already. So it was quite exciting. And they were one of the first groups to actually say, no, you know what, we believe in life sciences and we're going to go at this. And I think at the time it was GIC and Cadillac who were sort of in the final rounds for bidding for White City Place and really believed in the sector. So I thought it was interesting as a new shop to say, okay, no, this is a new asset class, but we're really interested in it. We're behind it. And we have a platform investment strategy where we're going to put large checks against this and also invest in the corporate. And just, I was fascinated by Jenny because there's such few women in real estate who are in the investment side who have built a career over the long term. I hope she's not watching this, but I was like stalking her and being like, this woman is amazing. And she had posted on this group called Women in Real Estate that I'm a part of. And I found that link and literally just sent my CV to her directly and was like, if you're hiring, I'd be really interested in working for you. And at the time, she didn't have an office and she interviewed me on a Zoom call from her house.
It was just her, because she left KKR.
She'd left KKR. I think she was at HIG at the time. She'd left HIG, and then it was her and Peter Angelopoulos, who's a senior director on our team. He'd come over from Canada. It was just Jenny and Peter. And they were the only two people I spoke to. And we had an office not too far from here where we are right now, near Oxford Circus, and it was a serviced office, and we were there for about a year, and it was only like I think 4 or 5 people in the beginning. Yeah,
so really small,
but
with some unbelievable firepower behind.
Yes.
So can you just talk to me about Ontario pension plan and that money and ultimately who is the ultimate stakeholder there?
Yeah, so Cadillac Fairview is wholly owned by Ontario Teachers. So we're basically a subsidiary of Teachers. Historically, Cadillac Fairview has been a development shop in Canada. So we have a lot of malls in Canada and a lot of office as well. They've built quite a bit of the downtown Toronto center, like what you would call the city in London, and because they've sort of cut their teeth on development, we're very comfortable with development and have sort of a large development and property management operation in Canada. And then there's the international investments aspect of it. So we have an investment team in Canada who does deals across asset classes as well. There's been a strategic shift to deploy that capital outside of Canada into various asset classes and diversify out of sort of office and retail. And so we've been looking at life science. We've also been looking at office in Europe, in the UK, residential primarily in UK with Long Harbour, as you mentioned, our JV, but also looking at it across Europe, potentially looking at student now as well.
So was there any part of you that thought it was quite a risky move to such a small yet very well capitalized business that's clearly looking globally to diversify its risk and get into new markets, but could turn the taps off at any moment because they're spooked by the market or actually they've got to change the strategy?
Yeah, I mean, to be honest, I probably should have been more worried now that you put it that way. And it's funny because when I remember speaking to Jenny, she was like, yeah, that was really brave of you, I've spoken to people and like everyone is not as brave. And I was like, oh, I guess I made a really big decision to
naively or just worshiping.
I was like super excited. I thought it was amazing. There's always that risk. Obviously, it's safer to be with a group that's established and has been doing, let's say, Europe for a while, and won't get spooked or change their mind. But it was clear to me that they were invested. I mean, they'd done a large ticket with White City Place. They were already looking at quite a few different things. And when I was interviewing with Jenny, she'd laid out to me that they were closing the Long Harbour JV at the time. And so they had a strategy moving forward and they were clearly very much invested in deploying that capital.
Yeah, I was going to ask, what was the strategy defined at that stage that you were coming in, or were you part of like that core team that was kind of defining it and working it out as you went along?
It was set at that stage that we would be focusing on these asset classes with these partners. Of course, there were newer strategies to focus on as well, but given team size, you can't always do everything. So we've expanded. We're now 15 people, and we're starting to tackle some newer strategies, namely looking at life science and student in Europe as well. But yeah, at the time, it was really sort of getting your main food groups and deploying in the strategies that you've already identified.
So logistics, living, or kind of residential, and then life sciences.
Exactly.
And you work on the living and life sciences part, is that right?
Yes.
But not logistics.
I don't, but I did initially meet when we were looking at various JV partners, Louis Simon, who's at Boreal, and when we set up the JV with them. And I mainly cover Long Harbour and Stanhope.
So you've obviously sat on the GP side at Hines.
Yeah.
You've now flipped to
the LP.
To the LP side. Is that a difficult move to make? Or is it more of like a mindset shifting from one side to the other?
It is a bit of a mindset, because I remember being on the GP side, and sometimes there's frustrations with not fully understanding where they're coming from. And now I'm on the other side. I'm like, okay, I get it now.
Can you expand on that? Like what kind of things?
Yeah, you'd pitch deals and you'd be like, well, but you can see that this is the IRR I'm presenting to you, and it's like 15 and we're definitely going to get it. And you don't fully consider I think you do consider all the risks, but when you're on the LP side, I think you're definitely looking at it in the whole in terms of how this relates to other strategies. You're seeing a lot more as well. Because when you're a GP and you're so focused on one asset class and one geography, let's say, even if you're on other geographies, but a singular asset class, you're not looking at everything on a sort of macro level and seeing how the world is shifting. I think we see that. Because we're across so many things, and we really try to feed that back to our partners and say, okay, guys, we can see rates are moving in the US, let's say, and we think this is going to hit the UK. So there might be a bit of a bid-ask spread, but we don't think we should meet the seller's ask at this stage and perhaps hold off a little bit because we can see this coming.
And we can allocate that capital to somewhere in the US or somewhere else where maybe the risk isn't quite there, or it's more stabilized.
And sometimes if you're on the other end, you can be like, oh, why don't they get it? The deal is great.
It's an amazing deal, and like a lot of frustration.
Deal. Yeah, exactly.
So what advice would you give to an operating partner who wants to come and work for, or form a JV with an LP like Cadillac or one of the other bigger players?
Yeah, I think having a if you're a GP and you have sort of a defined strategy and you found this opportunity that you really don't think anyone's doing in the market, you found an angle and you think you can deploy quite a bit of capital within that strategy and get sort of a target return that perhaps outstrips others. I think that's like having that strategy defined and coming with a portfolio and saying, okay, I've done these deals in this strategy before. Here's my track record. And I have this many more deals in my pipeline that I can provide on year one. And I know we can target this and we can deploy this much in the next year. And then you have 2 or 3 people that you've identified, or perhaps you're already an existing team. And then you're like, okay, you have the track record, you've shown you can done it, you have pipeline, so we know you can do it next year because you've already identified the assets, and you have the team to do it. So you're kind of ticking all those boxes.
And there's substantial scale, and there's going to be a quantum and an exit value to someone else further down the line.
Yeah.
So how did you come about, or how did the team come about working with Boreal, Stanhope and Long Harbour?
How did
Cadillac Fairview kind of select or work with them as partners? I guess, do they follow that similar process that you just alluded to, or is it more kind of like from relations?
It was a bit of relationships, just meeting people in the industry, perhaps meeting agents who brought potential JV partners to us. I wasn't there when the Long Harbour JV was set up, but that's what I understand happened, is that we came over from Canada and started meeting various partners. We're kind of doing that in the life science and student space at the moment, where we're just talking to people, seeing who's out there, who's looking at deals, who's looking at interesting things and has strategies that they believe in, or perhaps we have a strategy that we have conviction in and they're aligned to that. And then just really, talking to various JV partners really and seeing where sort of the market is.
Building relationships.
So
talk to me about the 15 heads at Cadillac UK and how are they split?
So the London office covers Europe. We're 15 people, which is divided up into sort of Jenny as MD and now CIO as well. We have another MD, Chris, and Graham, who covers development and asset management. We have 2 directors, Peter, senior director, who I mentioned earlier. We have 2 associate directors, myself namely, and then a few associates and analysts.
So quite a lean,
it's still quite lean.
And lean on a lot of the external JV partners. So the Boreal deal, we actually had James Farmer on the podcast who kind of gave
you told me.
Gave insight to that structure, but that's really exciting in terms of a £3 billion.
I should have listened to what he said to not contradict.
Well, the thing is, you're not working on that deal, so I'd say if you want to go and listen to that, you can go and listen to James's podcast where he was kind of talking all things Boreal and their kind of plans to expand and the pan-European logistics side. But you work on the kind of the BTR and the life sciences JV with Stanhope and Long Harbour. Can you just tell me a little bit more about those markets and the dynamics that you're seeing? Because they're very like hot and current, and there's a lot of money chasing them.
Yeah, in Resi especially, I think BTR, it's calmed down a little bit, and some of those bid-ask spreads I was mentioning are there. I think we need to wait for those to come in a bit more because cap rates have been coming up, and so we're seeing sort of that shift in the market. I think the question is like when you actually choose to sort of start investing again, and no one wants to catch a falling knife, and so there's always a bit of a hesitancy where like when do we step in again and when do we start actively deploying a capital, and we are still actively deploying, but we want to make sure we're doing it at the right time. And so in residential, for example, we are seeing deals come through. There has been a slowdown in movement at this time in the market, but there's still deals happening, and there's still a lot of capital that's allocated to Resi. And in life science as well, there have been quite a few sort of more development deals that have come to the market. And so the two recent deals that I worked on were in Cambridge Science Park, where we're looking at a lot of life science assets there.
And that's mainly, as you said, development, just because there's not the existing stock from an investment perspective at the moment.
Yeah, so on life sciences, there is the existing stock, but it's quite outdated. And so there's been a lot of VC investment into the life science space, and there's a huge demand supply gap where a lot of these pharma companies or biotech companies who need the space, who need the labs, don't have them. So there's a massive amount of demand looking for labs to rent, which aren't available because that really hasn't been a sector that people have invested in sort of, let's say, the past 5 years, and now the supply is coming.
And especially with that asset class, location is so important, right?
Yeah. So you want to be around these, like, they call it the Golden Triangle in the UK specifically, and then there's certain innovation clusters in Europe as well.
As an LP, you don't have to be a specialist per se. I guess you lean quite a lot on your operating partners, but you've got to know enough to be able to check, challenge, hold them to account, and ultimately go to Jenny to kind of get sign off on the decisions. From a residential perspective, it's obviously a more mature market, but there's a hell of a lot of capital that's been like pouring into it, and there's a lot of different products that are coming out as well. Can you just expand on how you're seeing the residential market and where the opportunities are?
Yeah, so I think there's still quite a bit of opportunity in build to rent. With Long Harbour, we've managed to sort of differentiate the product in terms of, and they've shown this in the assets they've delivered as well, that the level of amenity they provide and the quality of the asset they provide can achieve those sort of outsized rents and really maintain occupancy as well. And so there's so much demand in the UK, especially for rental residential. There's a lot of changing regulations, so there's been an effect on supply as well because buy to let has gone down because of tax reasons. Smaller buy to let investors aren't able to make their return, and so when you take that off the market and a lot of those assets have sold, there's just less property available to rent. Rates are rising, so the cost of a mortgage is now higher in the UK than renting an asset on average, and so we're seeing that sort of demand come to the residential market. And so there is quite a lot of scope in that and sort of the demand and supply fundamentals for Resi.
Hence, you guys are backing it long term and piling a lot of capital into it. Have you ever had a mentor throughout your career, or?
Yeah, it's kind of changed over time. So I think I mentioned briefly at in the beginning of the conversation, Tal Metzger, who I only interned with for a summer between my first and second year of my master's program. But I've somehow always gotten him to be a reference because we just connected and I've always asked his advice. Alex Knapp was a great mentor when I was at Hines. He's always sort of given me great advice on what to do and just guided me. And yeah, I guess mentors change over time as you sort of progress in your career.
So they're your bosses that you've kind of lent on for advice and you've learned from, but you haven't had anyone kind of external, as it were.
No, not, in terms of advice, I do lean on family members a lot, but yeah, it's always been sort of people who I've worked with, really.
What advice would you give to someone who wants to get into the real estate investment management or private equity space?
I think, especially students today, I think there is that fixed career path that I was mentioning before, like you do an economics or finance degree, for example, and then you do 2 years of banking. But I find that when you do that sort of career path, you're not really touching the asset. And what I've seen, that people who like understand the asset, like the fundamentals of real estate, you're able to cut through the noise in an underwrite and really get to the bottom of why it makes a deal special or not. So I know I had a sort of odd path into real estate, but I think it really, really helps. And I think working at a development shop, working for an agency, and really, really cutting your teeth and like boots on the ground, understanding the asset class is really, really important.
Yeah, because in your relatively short career, you've had a few different roles. Have you always been driven by like the money and the paycheck, or is it more about like the learning opportunity and like the exposure that you can get?
It's been the learning opportunity. There's been times when my paycheck has gone down, but I've seen opportunities in sort of learning more at the next role, just because it's brought me closer to an asset class that I wanted to do or a type of investing that I wanted to do. And so I think especially early in your career, it's important to focus on like, what am I getting out of this job in terms of my eventual growth, and what am I learning? And that's really what's going to carry you.
How important has like network been, and networking events, whether that's from like a deal flow perspective or just general networking? How much emphasis do you put on that?
Yeah, I think networking in the sense of like not just going to networking events, but also like establishing a good relationship with your counterparties when you're working on a JV. Even if you're a junior on a deal. So when I was at Cabot and Forbes, I was like the most junior person on the deals. When I was there, I was the analyst who was just like doing the initial underwrite. But I got really close to the founder of Blue Vista Capital when they used to visit out of Chicago, Rob, who then ended up connecting me to a bunch of LPs in London because he'd worked in London 20 years ago. So I think just making those sort of personal connections really, really matters. And it'll eventually, you don't know how, there's always like 6 degrees of separation, and you don't know how anyone is connected, and whether that's an LP or whether it's an agent that you're talking to on a deal. Anyone can sort of connect you, and the property industry is so small at the end of the day. And I feel like just talking to people will help make those connections, and you don't have to be the most senior person on the deal to be able to make those connections. I mean, Rob and I went to a football game together and we were sitting together. I worked up the courage to have a conversation with him, and we just clicked. We
text, don't we, when Pakistan play England?
Yeah.
in the cricket. I forget the scores, like who's up, but yeah, it's definitely when that's on, I flick you an odd text just to see, have a bit of a chat and a bit of banter about that. At the moment, what are the biggest challenges in this current environment as we're in like the middle of May, navigating this time? Is it just waiting to see what's going to play out, as you alluded to earlier in the conversation?
Yeah.
You don't want to go too soon. Is it better to kind of wait and go a little bit late rather than go a bit too early and have your kind of reputation tarnished? And ultimately, I guess you've got a fiduciary responsibility to not lose capital for your investors, especially if it's a pension fund back home.
Yeah, and it's always a bit of, it's hard. It's very difficult, especially at this time in the market. As you said, you don't want to go too soon, but then you don't want to miss the opportunity either. And sometimes the window is so small. And these things are so difficult to predict. Anyone that says they can predict it, it's impossible. You can never time the market perfectly. I mean, if you look back at 2010, there's people who say, oh, anyone who did a deal in 2010 hit it out of the ballpark, because it's just timing. If you did it, you didn't have to do much asset management either. You just timed it right. Cap rates moved. And by the time you exited, you were golden. And so it is a bit of working up the courage as well to do deals in a market that's moving in the wrong direction, because it might start going up again and you might have missed it. But then you also don't know if there's another downturn coming. So it's always tough at this time.
Talk to me about why, because you alluded that earlier. Can you it's women in real estate? I had Audrey Klein, who's a...
oh, you did?
Yeah, so yeah. I don't know if she's the chair lady or she's one of the founding members.
Yeah.
I had her on the podcast just talking about
great.
her background and career, but more from an investor relations and capital raising perspective.
Yeah.
Can you just talk to me about that organisation and how much emphasis... or the events and what they do and your involvement with it?
So I'm not on sort of the committee of women in real estate. I've been one of the members and I go to their events, but I think it's great that they sort of promote diversity in the industry. I mean, when I was the only woman in my first job, and even my program, I was one of 2 women in my entire real estate program. And so just having that diversity, and it's not only diversity for the sake of diversity. I always say this because at the end of the day, I think there is a different sort of investment mindset as well. There is a difference in how I think women also approach deals. Sometimes they can be more detail oriented. They can look at how the asset is managed for the long term more so than just like doing the deal on day one. And so I think you need to sort of round out that sort of investment ideology. If you have everyone that's the same on an investments team and you're all doing the same deals, you might end up in a bubble where you don't really know what's going on because an echo chamber. And so you want to bring in more diversity to get a diversity of opinion, right? And that's really what matters at the end of the day, is a diversity of opinion, because then you can make the right investment decisions.
100%. And I think, diverse teams, outperform non-diverse teams over and over and over again. And I know there's lots of different numbers to corroborate that.
I wish I had like the exact sort of citation for this, but I read somewhere that if you have like 50% women on an investment team, in the long term, they perform better rather than just having...
Doesn't surprise me. Doesn't surprise me one bit. As we kind of draw this conversation to a close, what are you kind of most excited about as we look forward to 2023 and 2024 and beyond?
Yeah, I think I'm excited to see how the market sort of settles and where the new opportunities lie. I think as we move into sort of a new sort of cycle, it'll be interesting to see, especially like post-COVID, how that affects sort of the office environment, how that affects the way we work, live, and play. I think that's still a bit to play out in the markets. We've seen it a bit in sort of Resi, for example, where it's great to have sort of a workspace where in your living room, because people work from home a bit more, or you need to change your office environment because you need to draw people back into work. So it needs to be a more vibrant office environment. But I think we're seeing that. And I think for 23 and 24, as markets shift, I think people will need to see, okay, what is driving occupier demand and what do we need to focus on? And then different strategies as well. I'm excited about like a variety of different asset classes, which, I mean, we have a specific scope at CF, but I think there's so much scope in a lot of things.
And do you really dive into the data, and what data do you dive into kind of like identify and look at those trends?
So at CF, we look at a lot of different trends in data. And so we look at sort of more fundamental research at like what's driving demand in different sectors. Yeah.
Cool. Well, look, a question that I ask everyone who comes on the podcast is, if I was to give you £500 million of equity, who are the people, what property, and which place would you look to deploy that?
I remember we spoke about this at the beginning. You were like, do you want the CF answer or the personal answer?
I'll give you $1 billion. I'll have the CF answer, and then.
So I think for CF, we need to do like the main food groups, right? Because we're still sort of early stage. Yeah. So it would be life science, resi, logistics, and we're already quite invested in those, but also diversifying across geographies, potentially student. We're starting to look at that and looking across Europe. We're also looking at credit, which I think at a time in the market right now is interesting. And so for CF, I'd probably invest in all of those food groups.
Yeah, 500 million isn't exactly much, is it? Given CF's balance sheet, it's a little drop.
Asset class.
Hence why you asked.
I cover Long Harbour, so I'll put it all to resi.
Good answer.
But yeah, the personal sort of, I feel like I've always been maybe perhaps more opportunistic, but always a bit different in my I like the oddballs, and I always look for sort of the arbitrage and like where things are going, sort of a more of like a cultural level as well. It's not just the statistics. It's like, what is the pulse of the market? And so personally for me, I think I would do film studios, cold storage, and data centers. And the reason is because I think we're spending a lot more time on our phones. We tend to order our food online more and more. And as demographics change, that's going to happen more. And so we're going to need more cold storage. Film studios, because the amount of production, if you look what we're doing right now,
content studio,
the content,
it's
a content Rockboard podcast. I'm backing you, Matt.
Yeah.
I think there's just so much more content. Yeah, and you need more space to keep producing that content. Creative industries are growing, and then you need data centers to store that content.
So they're the kind of the properties or the asset class types, and which locations, and then the people as well, and people.
So I think people, Boreal, Long Harbour, and Stanhope.
Good answer. Outside of that, we've been looking at a lot of JV part. I think when identifying people to invest with for us is really sort of the developers who have cut their teeth on the asset class. And so I think when we're looking at new sort of strategies or asset classes, it's really the people who have done the development or the people who have managed those assets, the PMs themselves, that are interesting because they have the most experience with that asset class, rather than going with a PE fund who
has the relationships with the LPs, but perhaps doesn't have that sort of direct sort of operating or asset management experience.
Because before, that's normally what would happen.
Exactly.
And so you guys are kind of cutting out that kind of commingled private equity fund, and you're going
we don't invest in we'll do JV. So for example, the Long Harbour JV, we have PSB as well. It's or we'll do club deals, but we don't invest in sort of funds with discretion.
Broad discretionary.
Broad discretionary funds.
Because you want the control, or you want oversight of the returns?
Control, oversight, more alignment with management, more influence on strategy.
Fees, does that come into it in terms of like eating into some of the returns?
No, I think the fees it doesn't move the needle as much. Yeah.
People, did we answer that, or are there
We answered people, we answered property. Did we answer? We didn't answer place.
Didn't answer place. Tell me, where are you going to do that?
I think the UK is still interesting. I hope we get out of this sort of recent downturn. I still quite believe in the UK as a market across asset classes. Europe, definitely. I don't cover APAC, but I think those geographies are like India is going to be massive. I think it's going to outstrip China. But yeah, definitely. I think UK and sort of France, Germany.
Good markets and certainly lots of growth. Well, look, Wajeha, thank you so much for joining me on the podcast today. I've loved hearing a little bit more about your background, story, views, and career moves. So you've certainly inspired and educated me, and no doubt you'd have done the same for people listening back at home. So thanks so much for joining me, and looking forward to catching up soon.
Yeah.
Cheers. Thanks. Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockborn.com where you can find a wealth of resource to aid your search. Have a great day wherever you are, and I look forward to catching you next time.